RBI is signaling critical shifts, a significant revision in the inflation projection down to 2.6%. So today we will dissect how these factors, the macro context, the policy decisions, and the regulatory mandates will specifically impact. Will provide a detailed presentation on the MPC's decisions and other key announcements.
So very interesting phase we are in as far as the banking system is concerned. Now, my dear friends, that's what we were talking about, the economic landscape that is now emerging despite the geopolitical risks and the global trade disruptions due to point cut was there. And then again in April, 25 basis points, and in June, there were 50 basis points, total taking to the 100 basis point as far as the repo rate is concerned, down from 6.5 to 5.5. And the upfront 100 basis point reduction in the CRR. So on that platform, that is the change that has happened. It is going to make a lot of difference as far as the daily goods are concerned. So it will have an impact on the economy as well through the inflation, as to how the inflation is going to work out in the coming times. Now the 5.5% as far as the repo rate is concerned, and as a result of which the corridor of liquidity, the average headline inflation for 25-26 has been 3.7%. That was earlier projected, but now it is brought down to 3.1 in August. And it provides a kind of stability, and instability risks are always there. Instability risks cannot be ruled out, but then we are in a very good position as the economy and the inflation dynamics are concerned, growth and inflation dynamics. So these are all some of the contributing factors that makes up the economy strong and strong. And as of September 19, 2025, the area sown under kharif crops. But sometimes I saw some data points where the GVA was higher than GDP. Maybe some reasons might be there. So RBI revised its outlook of GDP to 6.8% from earlier it was 6.5. So liquidity, we are very good as far as liquidity. RBI is having a very hawkish eye on the liquidity, 2.1 lakh crores surplus. Now, what is the reason for the transmission that is now very faster when compared to earlier? Because nearly 61% of the total loans are now linked to repo rates. That is what we call external benchmark rates. So all these have a cumulative effect in bringing down the current account deficit. So current account deficit, we are very comfortable.
We are in a Goldilocks situation. Growth is high, inflation is low. This gives probably a sense of satisfaction. Despite global headwind, we are doing extremely well. Now coming to highlights, as you all know, Monetary Policy Committee unanimously decided to keep the repo rate unchanged at 5.5%. As RBI is communicating, is guided by more clarity on geopolitical and geoeconomic risks. The governor has admitted that in the backdrop of changing inflation growth dynamics. Then one unspoken concern which might have prevented MPC member to cut the rate right away is the pressure on INR. But at the same time, the tailwind that is there in the economy, one is the outcome of GST reform. Yes, our export will suffer. So if you see that 7.8% growth in the first quarter is real GDP growth. We have gone for GST reform, we have gone in for regulatory changes, transmission is taking place, and our macroeconomic fundamentals are very strong. Foreign exchange reserves are also high. Okay, this RBI projection of 6.4% in 2025-26 is the last projection by IMF. They may revise the projection now. Once the prices are reduced because of cutting the GST, it will remain in force for at least 1 year, according to because I am provoking you to ask me question, because the 4% and 4.5% inflation in the fourth quarter and first quarter of the next year, these are clear overestimate. So anyway, the credit growth will also come down. Growth is likely to suffer not only because of export, but also domestic production will suffer. EBLR based 100% transmission is over. MCLR only 40%. Now, overall effect is 58 basis point. If you see the outstanding basis, 55 basis point. Concentration risk will increase. Risk-based premium for deposit insurance, that was very much recommended by the committee. So they are now going to implement it. And this will be implemented sometimes in next year. Credit growth will definitely be slightly higher than that at this point of time. But the enabling condition will help increase credit growth to some extent, but it is unlikely to be spectacular. So internationalization rupee is a medium to long-term strategy. It cannot take place so quickly. Anyway, additional reference rate to be published by a bill. Why are you delaying? So it is a lost opportunity to support growth, particularly when retail inflation is near the lower bound and real interest rate is very high. Second, inflation forecast for Q4 2026 and first quarter of 27 are on the higher side.
Well, friends, let me just quickly recapitulate before I come to my allotted subject of earlier they revised it down from 3.7% to 3.1%, and this time they have revised it down for further from 3.1 to 2.6%. Now, on the fiscal side, you would have seen first in the budget announcement, certain measures were announced in order to boost up the demand, both in the urban sector and by reducing, say, interest rates. And before this policy, transmission of the 100 basis points rate cuts that have been announced has not as yet. We will talk generally what has been stated in the policy in the context of the sectoral impact, and we will talk about what kind of impact it is going to have with the announcement of the measures, whether it is tier 1, tier 2, I think, and overall capital adequacy. I mean, those numbers are very good. Return on assets is relatively much better. Return on equity is improving. So banking system seems to be quite strong and resilient as at present. The guidelines that they had issued on enhancing credit supply for large borrowers through market mechanism, in terms of which, on an aggregate basis, borrowers which are enjoying limits of more than 10,000 crores, that has been increased to 1 crore. That is one particular measure that has been announced. If you look at the other guidelines, it is going to impact the balance sheet of the bank in a very significant basis and bring down the capital adequacy by some estimates by as much as 300 to 400 basis points. But potentially what they have done is they have given the time to the banks to implement it in a phased manner starting from 1st April 2027, and glide path has been given to complete the process so that there is minimal impact on the profitability till do away with the potential fraud that has to be. Otherwise, only for provisioning norm, these guidelines have been introduced. One very beneficial announcement that has been announced for the banking system is, but particularly it will benefit the strong banks to the individuals against the same. Similarly, for IPO financing, earlier the limit used to be 10 lakhs, that has been increased to 25 lakhs. So you would be in a position to, similarly, there are so many other guidelines that have been revised. Draft guidelines have been already posted by Reserve Bank of India on its website for comments, and they are yet to be implemented, but that is what they are proposing. Now, once these guidelines get implemented, so this is some of the measures that have been announced are positive. Some of the measures, though it is beneficial because RBI is required in respect of operational projects under PPPs and with a view to further rationalize the risk weight in line with the advanced risk profile of operational projects, they have decided to go in for a principle-based framework. And there is a requirement of consolidation of regulatory that's also not having. But this review of restriction on transaction accounts, I think they have already announced it on their website. with a view to objective enforcing credit discipline among borrowers up to 10 lakhs. Now that facility is also being given to the importers for reconciliation on declaration basis, so far as import data processing and monitoring system is concerned. Rupee, that's a very, very significant measure according to me, and that would definitely be. And then additional reference rates to be published by, and in 3 installments, 75 basis points further reduction in CRR is going to take place. I do not know whether it is overestimation of 4.4% and inflation in Q4 or 4.5% in Q1 of 27. I'm not very sure about that. So I was always believing probably they are giving us an indication that inflation, though it has come down, it has not come down on a sustained basis when they come out with these kind of projections, that in Q4 it is going to be 4%, while in Q2 and Q3 it is going to be 1.8%.
Ask your question, whatever you have in mind about, because there are so many things which have happened in this particular policy, which are affecting banks straight away.
So if that rupee accumulation can be permitted for extending ECB, similar to ECB loan to the Indian parties, in addition to the whatever avenues of investments are available.
Why
Of course, but
Shall I respond?
why we are worried about NIM until and unless we go below 2% or 1.5%.
Definitely it is going to have impact on the profitability of the bank. Yes, they should come down, because if they will come down, there would be higher and higher volumes that may get generated. But that growth is still not taking place in our economy, which will justify NIM of 1% or 1.5%. That's my, Dr. Boyle Saab can.
Area, the bigger question is the large borrowers are getting some benefit, right? So banks can give higher credit to large borrowers. Now, there is also a news item which is floating that the commercial banks, bigger commercial banks, there will be a consolidation kind of a thing, like mergers which happened in last 10 years.
That it is the concern of the government, at least I can say, that they want our banks further mergers and to take place, so that we can have very, very large size banks which can feature at least amongst the first.
Are the borrowers that interest rate sensitive? Because there are two groups of banks, one groups of corporates, one who can tap other sources.
This is regarding the UCB segment, urban cooperative bank segment, right? There is a new discussion paper which is going to come, which is going to maybe issue new licenses. Now, in this year only, we have seen one big collapse of New India Assurance Bank in Mumbai, and that has got merged with Saraswat Bank.
Yes, why not? See, the internal working group has already recommended some time back, even small finance banks, that should not bring the factor that no more cooperative banks or no more banks and all those things, because the market is quite wide and there are very efficient banks which are running well. There are 1,500 urban cooperative banks, 1,450 or 1,500. So one bank, yes, that New India Cooperative Banks has been merged with.
Where can't we come out with a new set of guidelines which would enable emergence of healthy urban cooperative banks going
Yeah.
on? There is so much of what would happen. This can be capital market exposure. It's a very risky exposure, and it has its own implication. But also we have to look into what he has stated is, when was their last revised to 20 lakhs? That risk appetite has to be determined by that board. If I have the capital to take much higher risk, I can. Now, if they have come and they are, if there is a uniform structure that everybody has to pay on assessable deposits, 12 paisa per 100,